The first rule of Fight Club, don't talk about Fight Club. The first rule of being in a drawdown is all you think about is the drawdown. Your entire and so like again, we're just human beings and we have to accept that and acknowledge that and realize that this game is hard. We're not going to achieve our long-term strategic investment objectives overnight. So let's just make a consistent series of good decisions along the way so that we can, put ourselves in the best position for success.
Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Darius Dale, founder of 42 Macro, to discuss his approach to managing his personal investment portfolio. Darius follows his own macro research style of investing, where he looks to determine if the economy is growing or slowing, and if we are in an inflationary or deflationary environment. As macro conditions change, certain asset and investment classes will be actively managed and represented in his portfolio over time. Darius walks us through his systematic macro approach to investing and why it works for him. As always, thank you for listening. Please enjoy this discussion with Darius Dale of 42 Macro. Hey, Darius, how are you?
Wonderful, man. How you doing, Justin?
Good, man. Good. Thanks for joining us again. We appreciate it.
Always a pleasure, man. Appreciate the content you guys are putting out, and thanks again for having me on.
We've been talking to investors like yourself and others about unique strategies and the way that they go about managing their personal portfolio and their perspectives on the market, and also how they think about their investing goals and their portfolio positioning and construction. You have a unique sort of systematic macro framework that we'll get into and that we'll talk to. But what we want to do is sort of talk through how that translates into an actual portfolio. And also talk through sort of how you view that in terms of getting to and accomplishing your long-term investing goals. So that's going to be sort of the framework that we'll follow with the conversation today, which I think is going to be a fun one and an interesting one, because it's always good to get people with different, unique sort of perspectives on how they view investing in the markets over time. But to start, before we get to all the nitty-gritty fun details, we wanted to ask you about sort of just your long-term goals in investing. When you think about your investment portfolio and what you hope to achieve with it, how would you sort of summarize what your long-term goals are?
Oh, that's an excellent question. Because to me, I think there's not enough time in sort of the sphere that we operate in, which is sort of, financial educators, financial teachers, of helping the client, the end user, the subscriber, at the end of the day, the person whose money you're managing or helping to manage. We don't spend enough time helping them understand their own investment objectives, right? And so I'm really glad we sort of open with this, because, what's appropriate for me, Darius Dale, someone who's 35 years old, may not be appropriate for client at ABC who's in their late 50s or early 60s, or maybe someone who's 25 who has a much different, time horizon and income spectrum. So I do believe it's very important for all investors to understand exactly what it is that they are trying to achieve when they interact with services like mine or money managers, et cetera. So to answer your question specifically on my set, I grew up very poor. So my number one thing I think about when I'm putting capital to work at risk in financial markets is, to not lose it. I don't want to go back to the poorhouse. It's not particularly fun. I having had that life experience, I'm very cognizant of drawdown risk and volatility drag. Those are probably the two number one things that I think I do well in terms of my skill set and where my focus is from a portfolio construction perspective, and ultimately in terms of my investment objectives. If I can compound, to let's call it 7 to 10% returns in perpetuity with limited drawdown risk, that's fantastic. Some people might want 30 to 40, 50% a year and are comfortable with suffering 30, 40, 50, look at crypto, 70, 80% drawdowns along the way. And that's fine. With my overall net worth, that's not acceptable. But again, that's how I view the markets. I'm a kind of a slow and steady wins the race kind of guy, as opposed to someone who needs to be super long beta, super long high beta. There are times in the cycle, which I'm sure we'll talk to in a few minutes here, but there are times in the cycle where you do want to be leaning super long beta. And we certainly built a very sophisticated, very robust process for helping investors do that. It just may not necessarily be something that I'm comfortable with at every interval of the entire investment and market cycle.
Yeah, I think you bring up two very important points. The one is that everyone's situation is different. Your situation is different than mine. That's different from the person that's, viewing this, watching this. They could be at a different point in their life. And also sort of those formative experiences early on, your family not having a lot of money. My family didn't really have a lot of money either. I think back to Benjamin Graham when he lost everything in the depression, and then he focused on margin of safety. So those early experiences we have as investors or even in life sort of can stay with us and influence our investing philosophy.
Absolutely. And one quick thing to bring up on that, it's not just us in terms of our own trying to achieve our own our investment objectives. Think about everybody else in the market has these same, formative experiences that, kind of attack or help them formulate how they attack and approach markets. So, when you're trying to think about positioning, thinking about sentiment, it's not this monolithic thing, this investor consensus. There's, Darius, Jack, and Justin, and we all have three different ways of viewing the world and viewing markets.
This may seem like a little bit sort of a weird question, but we like to ask it just as we like to hear people's perspective. Like when you think of, and you've got, decades into retirement, but when you think about yourself in retirement, do you have a bit,
Hopefully only two.
do you have a vision or something you sort of see yourself doing or not doing in retirement?
Probably a lot of the same stuff that I'm doing now. Just I'll wake up at a much more reasonable hour and end at a much more reasonable hour. I love what I do, man. I think this game that we play, financial markets, certainly the sphere that I'm in, global macro, macro risk management strategy, portfolio construction, asset allocation, that stuff. I mean, to me, it's just like putting together this fantastic jigsaw puzzle that's never ending. You get clues here and there, and it's just a fun game. So, in my retirement, I don't really expect to do anything other than trade and kind of keep up with the markets, but certainly at a much lower intensity than I'm currently doing.
On the issue of you waking up, don't you wake up at 4 a.m.? I think you say on Twitter. Is that right? Every day?
4:30, 4:30, yeah, 4:30. Yeah.
That's crazy. I mean, I have to do that sometimes, but it's because a 3-year-old is screaming at me. I mean, it's not to start running my systematic process.
Yeah. Well, I guess I'm getting good practice. So I don't have any kids now, but I'm sure I'll have kids in a couple of years. So yeah, I'm getting good practice.
Before we get into your portfolio, I want to start at a high level. And for anybody who wants to understand your macro process, we did another full episode, another full hour with you. We won't get to cover everything here, but, and you can find that on our YouTube channel. But before we get into the process in detail, I wanted to see if you could talk about it at a high level. So we talked in the previous interview about your regime segmentation process, about this idea of changes of growth and inflation. And I wonder if you can just talk to that a little bit and how that translates into building your personal portfolio.
Yeah, absolutely. So yeah, we don't have to spend too much time on it. I'll refer the viewers and listeners back to that original episode. Certainly come check out our YouTube channel or 42 Macro if you want to get more information on the process. But I'll be quick. And just in terms of like thinking about the world, asset markets are, from our perspective, in terms of the back test that we've done, that spans several decades, going back to the 60s, 70s, pick your asset class. It's very clear that asset markets, the primary driver of dispersion within and across asset markets are changes in growth and changes in inflation. And more importantly, especially in this most recent kind of 12 years or so, how central banks are reacting to those changes in growth, changes in inflation, and more importantly, especially with respect to this market cycle, the level of growth and the level of inflation has to really come into question as well. So it's our job as an investor, and certainly our process is really oriented around understanding the trending rates of change of those variables and forecasting the trending rates of those rates of change of those variables in order to identify sort of what regime we might be in. In kind of the best of times, we're in what we call Goldilocks at 42 Macro through the lens of our grid model. Grid's short for Goldilocks, reflation, inflation, and deflation. Goldilocks is where growth is accelerating and inflation is decelerating. You tend to have outsized, excess returns in equities and credit, crypto, risk assets in general. Reflation is where both growth and inflation are accelerating simultaneously. You tend to have outsized excess returns in those asset classes, including commodities as well. This is where fixed income tends to have most of its negative absolute performance. Then you also have what we call inflation. That's where growth's decelerating and inflation's accelerating. You tend to have negative, sort of absolute returns and risk assets. The performance across fixed income markets tends to be mixed. Typically when you're above, call it 4 or 5% inflation, you're going to have negative absolute returns in fixed income. When you're below that threshold, you tend to have inverse covariance to the equities in that asset class. And then lastly, deflation. That's where both growth and inflation are trending lower. This is about the asset class. That's the sort of regime where the concept of the 60-40 portfolio really got going in terms of the inverse covariance you tend to see in stocks and bonds in that regime. And so understanding how asset markets have historically performed, both on a relative and absolute basis, across some very critical features, including expected returns, percent positive ratios, volatility, and covariance, is really critical and sort of foundational to how we think about managing risk and constructing portfolios. So again, to kind of summarize, we need to know where we've been and where we're headed from the perspective of that grid regime cycle, and ultimately how asset markets have historically behaved through, again, expected returns, percent positive ratios, volatility, covariance, in order to understand, hey, what are the types of securities, asset classes, factors that will come together in a more, kind of in an elegant way to help take advantage of our forecasts for the economy.
And that sort of gets into my next question, because one of the common wisdoms you'll see out there is, just get your 60/40 portfolio, tuck it away, don't be active, don't change anything, come back in 40 years and you'll be great. And we've kind of had a period where the 60/40 portfolio had one of its best periods in history over the last 40 years or so. And I'm wondering if you can maybe talk about why that approach, when you think about your personal portfolio, why that 60/40 approach may not be as positive going forward as it has been in the past 40 years.
Yeah, I mean, so look, I mean, so much of the returns associated with the 60/40 portfolio, kind of came alive in an era of disinflation, in an era of, peak globalization. There's a lot of good stuff that happened that made that, sort of kept the structural underlying trend of inflation down in order to kind of, help perpetuate those kinds of returns. And more importantly, you did, in terms of the drawdowns you saw, they're unlikely to be they're sort of the drawdowns we're experiencing today in the 60/40 portfolio, for instance, is significantly higher than the drawdowns we're used to in that particular asset class. Because again, I believe, and I think a lot of other investors believe, we're in a higher inflation regime that is likely to be persistent for some years. And so in terms of, my thought process on 60/40 is, again, even at its face value in a disinflationary regime, you still have some, pretty sizable drawdowns and volatility drag in that strategy if you don't understand, kind of where you are in the cycle. I mean, 2008 obviously is kind of one of the biggest moments in most investors' careers in terms of remembering that. But you had several drawdowns, throughout the 2020s, sort of throughout the 2010s and, 2000s, 2000 to 2002, 2018, obviously 2011, you had quite a few of these episodes where, if you time the markets wrong, or if you allocated too much to 60/40 at the wrong time and didn't necessarily have a macro risk management view that can get you into more cash, you suffered some pretty significant drawdowns, and it's hard. I mean, we talk about the back testing and the history of buy and hold and 60/40, and we see all those statistics, right? But what I don't see enough statistics are what happens when your portfolio goes down 20%, and, the length of time it takes you to recover, and, trying to fight back and claw back to break even or high watermark. And the reality is we don't spend enough time as investors understanding those dynamics and how that puts you on a very different path to achieving your financial objectives over the long term. So to answer your question specifically, Jack, it's just not for me. The drawdowns associated with that strategy are far too great for anything that I'm personally comfortable with. Somebody else might be very comfortable with that. But in my opinion, I just think, there's a better way to do risk management, which is, hey, if you want to be long stocks, be long stocks at the particular point in the interval in the grid regime cycle where it tells you to be long stocks. And if you want to be long fixed income, then reallocate out of stocks and allocate out of fixed income. You don't have to be long everything at all times, because again, being long everything at all times exposes your overall portfolio to higher units and higher degrees of realized volatility than you otherwise might be able to sidestep.
Yeah, well, one of the important points you make, and this goes back to what we talked about at the beginning about each person having a portfolio that's right for them, is this issue of behavior is so important. And, you talk about how drawdowns are really important to you. As somebody who drawdowns are really important to, like, this is a very sensible process to run. Like, for somebody who can just take 50% drawdowns and it's not even a big deal and they hold for 40 years, someone in VC or something like that, it could be a different thing. And, that's a huge part of what's right for you is sort of your own mental makeup and how you can withstand declines.
Jack, you and I both know those people don't exist.
That is probably true.
Funny joke on Wall Street, but like even institutional investors panic sell the lows, right? Like pension funds, asset allocators, these people who invest in these longer term asset classes like venture capital, angel investing, et cetera, still wind up having, causing outflows at the lows of these market cycles. And so, we're all human. Like, look, none of us would have a job. Me, you, Justin, like we would not have a job if the average investor had the ability to just invest and go away 10, 20 years and come back and look at their statement. There's something called behavioral heuristics and our myopic loss aversion and prospect theory that all prevent us all from doing that very simple thing. And because we are prevented from doing that very simple thing, literally by the makeup of our DNA and how our brains operate, we must engage with people who can help us minimize that volatility and drawdowns. I'm not certainly saying we've, figured out the atom. We've cracked open the atom here at 42 macro. I think we're getting close, to be fair, but, to the extent we're not, I still think there's a better way to do this, just given the constraints of us all being human beings and not being able to, be Warren Buffett. The reality is we're all on finance Twitter. We're all listening to finance podcasts. We're all prone to making decisions, checking our statement, repositioning, et cetera. And so if we're going to be making those high frequency decisions, let's make good high frequency decisions is all I'm trying to say.
It's funny, that's probably one of the most important takeaways here is like our own ability to be honest with ourselves about the drawdown we can actually take. Because, one of the things we've tried to do with clients we manage money for is, we try to upfront say like, here are the bad things that can happen with this particular portfolio. Here are the drawdowns. And, inevitably it'll say, oh yeah, that 50% drawdown, that's no problem for me. I'll be perfectly fine during that. Like looking back at 2008 and seeing that things came back, but living in the moment of those drawdowns, like it's very, very hard, even for people like us that are very, that or live in this business. It's very, very hard to say, like, live in that moment of that 50% drawdown and say, am I going to do something stupid? It's just so hard to do it.
Oh, it's 100%, man. It is. When you're in the middle of a drawdown, all you think about is the drawdown. It's like the first rule of Fight Club. Don't talk about Fight Club. The first rule of being in a drawdown is all you think about is the drawdown. Your entire, and so like, again, we're just human beings and we have to accept that and acknowledge that and realize that this game is hard. We're not going to achieve our long-term strategic investment objectives overnight. So let's just make a consistent series of good decisions along the way so that we can, put ourselves in the best position for success.
When we've done these episodes, we've typically put like a little pie chart in of the person's asset allocation. And we may not be able to do that here because I know yours is sort of changing over time, but I'm just wondering this sort of
I actually just tweeted it out. Well, it's not, I tweeted out with blurred, no, you don't see the,
with the blurred. So we may have to put the blurred pie chart in here this time.
But yeah, you can see the asset.
But I'm just wondering, and I don't want you to give away anything that you're, is proprietary to subscribers, but just in general, like if we were to look at your asset class allocation at a time like now, like what asset classes would be in there and kind of what would be the thought process of sort of getting to those asset classes?
Yeah. So that is, that kind of opens the Pandora's box on the actual process we use. So what we're trying to do, and again, as I kind of alluded to, we want to understand kind of units of risk, across the asset classes and sort of both across asset classes and within asset classes, again, through the lens of volatility and covariance. And then we want to understand potential reward through the lens of expected returns and percent positive ratios. And, so we help, one thing we do, I think at a very high level, is help investors visualize the relationships between different asset classes spatially in terms of those units of risk and units of reward. And so understanding that within asset classes, first we understand, hey, we're in regime A, B, C, or D, G, R, I, or D, and going to, over the next 3 to 6 months, the next 6 to 12 months, we're going to be heading from regime GRID to regime GRID. And if we stay in this, great. If we don't, what do we have to sell and buy along the way as a function of the changing kind of, volatility and changing, units of risk and units of reward. And so, that's kind of where we start from an overall asset allocation perspective, which is I should have, roughly X amount of Z based on the historical kind of dispersion across and within asset classes in fixed income, in stocks, in commodities, et cetera. And so that's kind of where we start. And then from there, we do it from a bottom up perspective as well. Okay. Let's say I kind of want to have, generally target 15, 20% commodities in reflation or inflation. Well, what comprises that 15 to 20%? Well, from a system, from a back testing perspective, let's just pick on crude oil here. Crude oil suggests, this is one of those things. Well, when we pop it into the portfolio, let's say, okay, yeah, we're good. We're comfortable being long the risk that is crude oil exposure. When we pop that into the portfolio, we don't just lick our hands and say, hey, well, this should be a 5% position, 10% position. I don't think that's a particularly, thoughtful way to manage risk. What we do is we use what we call our volatility adjusted position sizing process, which ranks all the Darius exposures we pop into the portfolio through the lens of trailing 3-year semi-variance, which is the volatility of downside deviations. And, the positions or the exposures that have a high degree of semi-variance relative to the sample are the smallest positions, the 3% positions. The exposures with the low degree of semi-variance relative to the sample, the sample of the actual exposures in the portfolio have the 9% positions. And then those in the middle have the 6% positions. And so based on this process of top down saying, hey, I generally want to target, and there's some, subjectivity to this. I generally want to target based on how stocks, bonds, commodities, et cetera, crypto have traded in this asset class, XYZ to the asset class A or B. And then based on, that kind of, bucket or sleeve, I'll go from the bottom up perspective and say, hey, look, well, crude oil generally tends, based on these kind of factors from a backtesting perspective, crude oil is a better commodity exposure than wheat. So let's go along crude oil, and then the volatility adjusted position sizing process will take that over.
So would the portfolio look like just maybe a series of ETFs to sort of represent these broader asset classes?
Yeah, absolutely. So I try not to get too exotic. I mean, quite frankly, I don't have time to manage exotic risks and also publish research and all this other stuff. So that's one constraint, but also understanding that we have, investors all across the investment spectrum, right? We have clients who manage trillions of dollars, across various, asset classes. We have clients who, run tens of thousands of dollars in their own personal account, right? At the end of the day, what we're trying to do is kind of, create signals and create actionable tools for investors that they can express and trade without having to have a PhD in finance, or, without having to have access to the most sophisticated trading systems, et cetera, et cetera. So generally speaking, we're long ETFs, we're long ETFs. Sometimes we'll go short ETFs, or, may go long options or something like that. But generally speaking, it's more on the vanilla side of things in terms of the actual vehicles we use to express our trades. But as you know, I mean, holy cow, I've been very proud of this just as a retail investor and someone who does what I do for a living. The breadth of ETFs in terms of like the, kind of the exposures you you get access to in the ETF marketplace, and the strategies you can get access to in the ETF marketplace are fantastic and growing pretty tremendously. So I'm really proud of that. And it makes my job a hell of a lot easier in terms of constructing thoughtful portfolios.
Yeah, to your point, I mean, the things you can do with ETFs now, it's pretty amazing. How granular do you get with that? So in other words, inside of bonds, are you high yield and corporates and, government, and then maybe inside of stocks, do you think about like momentum and value ETFs and things like that? I mean, how granular do you like to get?
Yeah, very, very extremely granular. So again, if it ticks from a factor a factor exposure perspective, we have back tested it. And so at the end of the day, in going back to that kind of process where we're trying to, spatially identify units of risk on a relative basis to the things within and across asset classes, and units of reward, we understand that at the factor level. So within stocks, growth versus value, size versus momentum, small caps versus consumer discretionary, all the way down to, at the industry level, at the factor level as well. Within fixed income, across different sectors of fixed income, convertible bonds versus muni bonds, short duration muni bonds versus long duration muni bonds. Like, if we can find that exposure represented by ETF, or at least, quite reasonably, then we will, kind of include it in that overall kind of portfolio construction process, that soup to nuts process, where we're starting with, hey, where we are from a grid perspective, where are we going? Let's understand risk versus reward. And then from that, we can sort of start to allocate to the various exposures based on their relative projected, risk and reward.
Yeah, that makes a lot of sense. One of the things people find challenging with their personal portfolios a lot of the time is rebalancing. And, so you have some systematic process, so it might be a little bit easier for you, but how do you think about that in terms of like how often to rebalance? I'm assuming, you probably could rebalance every day because your data is changing, but I'm sure you don't. So I'm wondering, how do you think about that? Like how often to rebalance, and how to balance that when you think about your personal portfolio?
Yeah, great. And so one thing we haven't even mentioned, I run all of my liquid assets with this 42 macro portfolio construction process. There's no deviation from what you'll see in my portfolio than what our subscribers see on the screen in terms of the changes we're making. So, when I talk about these things, I'm literally making every single change in my own portfolio. I believe in kind of eating what you cook. I believe in what I do. I think I'm really good at what I do. And quite frankly, I wouldn't sell it to someone if I didn't think it was something that's worth me doing for myself. But in terms of rebalancing, one of the things that we do here as well, in terms of helping investors kind of manage immediate term risk, because again, the portfolio construction process, the portfolio is designed to sort of take advantage of medium term risk, let's call it somewhere between 3 and 9 months on a rolling 3 to 9 month forward basis. That's kind of like our sweet spot in terms of our grid regime forecasting accuracy, in terms of our ability to understand the, Fed reaction function, et cetera, et cetera. So like kind of 1 to 3 quarters. In terms of the, shorter term risk management and rebalancing, we run what we call our probable range process that's associated with our volatility adjusted momentum signal. And when things get overbought, oversold across different asset classes, I think that's an appropriate time to be taking down or taking up risk. Generally speaking, I don't deviate from the actual target exposures, because what I'm really trying to do is just capture the overall return of this sort of, kind of, elegantly constructed portfolio. but sometimes things will go, super overbought or super oversold. For instance, recording today on Thursday, September 1st, and most risk assets, including actually no fixed incomes, also quite oversold. So a lot of things are oversold. Some things are more oversold than others. So if you're going to be kind of allocating and rebalancing, you can take advantage of some of those signals relative to something like for instance the U.S. dollar, which is extremely overbought. So that, in my opinion, I think when I think about rebalancing, it's more opportunistic, unless something gets, extremely out of whack on a kind of, 1 week or 2 week basis. And then I'll kind of just try to get it back in line. But generally speaking, I'm trying to stick to those volatility adjusted position sizing targets, because that helps us prevent drawdowns.
Yeah, to me, this is one of the most challenging things in running systematic portfolios, because we do as well. Is like you're always seeing these changes in terms of all your rankings and your scores, and it's like, when do we trade and when do we not trade? It's there's no perfect way to do it, but I mean, you have a very sensible way to do it. But to me, this has always been one of the toughest things about running systematic portfolios.
Yeah, and the good thing is, so our portfolio target weightings don't change very much unless of course, we change the entire sample. We add something or take something from the sample, then the relative semi-variance within the sample in terms of the percentile rankings will change. But like on a day-to-day, week-to-week basis, if I don't change the portfolio in terms of the exposures featured, those things aren't going to change. The trailing 3-year semi-variance is not something that's going to be swinging around on a day-to-day, week-to-week basis. So that's a good thing.
You talked about some commodities you own earlier. What other types of alternatives do you use in your portfolio?
Yeah, absolutely. So great question. So if I can understand it as an investor, then I'm comfortable with that exposure to the extent that it's been gone through the ringer from the perspective of our, portfolio construction process. It's an exposure that I, can back test and understand based on our grid regime, based on our forecast for things like policy, et cetera. So one mistake that I made this year, I think, is a great learning experience, which is, we were long, our friends over at Simplify have a managed future strategy ETF called CTA, that is the ticker. We were long that it was, performing quite beautifully. And then it had a pretty sizable drawdown kind of over the, very short period of time. I think it was, basically down like 4 or 5% in like 2 or 3 days. And I'm like, man, I don't really understand this, because I thought when I looked at the exposure, it was a managed future strategy. So, at the time it was, long short dated treasury bonds, it was long commodities, or, something like that. I'm just making this up because I don't remember exactly what, but it was long exposures that I was comfortable with based on our portfolio construction process. And then obviously, it was either stopping out or getting out or reversing a lot of trades, and, kind of the drawdown fed upon itself. And so at that moment, I'm like, well, I don't really understand what's happening. I'm not running the managed future strategy. I'm just long the output of the managed future strategy. So that's an example of something where, I didn't really fully understand what it is that I was long, or more importantly, I didn't understand how it could change on me, kind of in real time, on the ground. And so, that's kind of an example of something where that's a little bit too much of a black box, where we won't put into the portfolio construction, kind of having learned that lesson. But generally speaking, I mean, if there is an exposure that is a kind of a singular exposure, like, again, long-term treasury bonds, or, high yield credit, stuff like that, that's a factor that we can back test, that we can understand, and ultimately kind of can profit from and position for.
This is usually the point in the interview where I ask someone if they've changed their process to account for inflation, but obviously your process itself is accounting for inflation. So I don't want to ask that, but I do want to ask you around, one of the things I think a lot of investors have struggled with is sort of what to own in an inflationary period. Obviously commodities have done very well this year, but a lot of TIPS ETFs have actually not done that well. I'm wondering, you've studied this a lot. I'm wondering, what do you think, like, what is in your portfolio to help combat inflation? Like, what do you think the best assets to own in an inflationary environment are?
Yeah. So generally speaking, I mean, when you're in a let's talk about what high inflation means, right? Like, certainly relative to the disinflationary regime we're coming out of. And when you have high inflation, test this empirically, using data going back to the 1800s, higher inflation begets higher inflation volatility. Higher inflation volatility begets higher nominal and real economic output volatility, and nominal and real economic growth. And as a function of those two things, again, higher inflation vol, higher growth vol, you wind up with lower multiples in risk assets. And so that's sort of your general playbook. When you're in a higher inflation regime, understand you're going to have more volatility. It's going to be harder to forecast both growth and inflation. And as a function of that, investors are going to assign lower multiples to risk assets, generally speaking. And more importantly, high inflation regimes tend to have positive covariance with equity vol. That threshold is somewhere around 4%, actually, going back to what we discussed earlier. And so understanding kind of those kind of overarching guide signposts will help you generally kind of understand the amount of risk you're taking. Because I think there's two answers to your question, Jack, which is, what do you buy and sell in an inflation regime, but also how much do you buy and sell of it? When you're in this disinflationary regime that we're exiting, that we exited, you could argue, kind of in 2021, which is, hey man, the Fed's got your back. You can be long risk. Hell, you can be long levered risk at, long periods of time, throughout and across market cycles. Because again, the general trend, the path of least resistance over a long time horizon is up when you're in a disinflation regime and the Fed has kind of got they got the wind at your back from a Fed policy perspective. Clearly, that's not the case. I think 2022 has proven that. Or really, pick your asset class. You might make the case that 2021 started to prove it as well. But when you're in a higher inflation regime, the wind is at your face. You have a headwind as an investment perspective. So you probably should be, having less gross exposure on to asset markets in general. Because again, you're going to be experiencing higher realized volatility across asset classes. Again, both equities and fixed income and equity-like instruments, crypto, commodities, et cetera. And so that's a general thing. Cash is king when you have higher volatility. The average person will tell you, well, it's inflation's 8%, so you're going to lose 8% of your money. Well, I'll tell you, well, that's better than losing 25% of your money. It's not like you have good choices. Inflation is not good, unless you're along the thing that's causing the inflation at the right time. Obviously, people have learned the hard way this year that, just because we're in an inflationary regime doesn't mean you can be constantly be long inflation. We've had significant drawdowns in things like crude oil and energy, ag, industrial metals, et cetera, from their respective highs this year. So, kind of drilling down underneath it all in terms of what do you want to be long? Obviously, commodities as an asset class is going to be the solution, the answer to this over a long period of time, and commodity linked equities. Now, the problem with that is, again, those are incredibly volatile asset classes. And the more sort of, I wouldn't say esoteric, but the more specialized you get, i.e. going from, wheat to corn or, base nickel to palladium, the more specialized you get in terms of attacking, the commodity exposure, the more volatility you're going to experience. And so it kind of, begs it kind of leads you to a place where, if you're going to be having broader commodity exposure, you're either going to want that in a basket type exposure, or you're going to want that in kind of a managed account type exposure, i.e. like an alternative asset manager. Who knows what the hell they're doing in terms of managing drawdown risk in that space. So to me, I think we kind of talked about, 60-40, right? This concept of 60-40. To me, I think I think we're all going to end this decade as investors with the concept of 60-30-10. Like it's just, you got to make room for alternative assets, namely physical and digital commodities at the expense of fixed income. Because again, the ex ante returns for both stocks and bonds, to be quite frankly, are going to be lower than they have been in this most recent era. And so I think that's, this concept of 60-30-10 we're trying to popularize here at 42 Macro. And again, I think by the end of the decade, it'll be kind of, consensus across Wall Street.
Yeah, and to your point on commodities, I think commodities are probably maybe the number one asset class that needs some sort of systematic or quantitative process tied to it. Because when you don't want to own commodities, you really do not want to own commodities. As we saw a period, in that decade where they did really poorly. I mean, it can be, commodities can be a really bad thing to own at the wrong time.
Yeah, and they're extremely like not mean reverting. I don't know. I'm sorry. They're extremely stochastic and they can be mean reverting. But when they stop going mean reverting and they just start going down, they will go down for years. You don't get a chance to get out when you suffer a drawdown in commodities and the cycle turns against you. Unlike equities, which you got a whole community of people who's trained to buy cheap stocks, right? So you get these opportunities, you get these bounces in the stock market. You don't get those bounces in wheat and palladium. If the palladium goes no bid, it's going to lose 50% its value and stay down for several years. You know what I mean? Like that's the kind of risk you're exposing yourself to in the commodity space. So again, it's a higher volatility asset class, but again, it's one of the most obvious expressions of trying to take advantage of a higher inflation environment. Not necessarily because commodities have to go up when inflation is high. It's just that you're probably going to have more volatility in other asset classes, which will, just from a VAR perspective, is going to cause a lot of investors to take down their risk to things like fixed income and equities at the margins for a sustained period of time. And they're going to be looking for other avenues to park that capital. And I do believe strongly that physical and digital commodities, like Bitcoin, et cetera, are going to be very big beneficiaries of that from a structural perspective. Now, that doesn't mean you need to be long these things every time, right? We've seen, again, 20+, 30+% drawdowns in ag, energy, industrial metals, 60 to 70% drawdowns in Bitcoin, Ethereum. So clearly at every interval of the market cycle, you don't need to be long these things, but just in terms from a strategic asset allocation perspective, you shouldn't be sort of blindly rebalancing into 60-40 at every drawdown in this year. You should be thinking about how does that 60-40 go to 60-30-10 over time, in my opinion.
Going back to equities, how do you think about valuation when you build your portfolio? So guys like me have been talking about like, high valuations and low expected returns on equities for a really long time. And, to be honest, we were wrong for a long time and then maybe we were a little bit right. But how do you think about, valuation is so tough from a timing perspective. Like, does that play a role in your process?
Not really. I'm cognizant of valuation, like from a perspective of overall market risk. But generally speaking, like to me, I think valuation is, it's more of an opinion, right? Like if something you can empirically observe, hey, this on this particular valuation metric, something is very high because it's in the 100th or 90th to 100th percentile of its historical time horizon. But does that necessarily take into account all the factors of why, this time series itself could be stationary or non-stationary, right? Like something like the PE multiple of the equity market, in my opinion, it should not be this like stationary thing. If you're in an environment where interest rates are continuing to fall, the Fed's balance sheet is continuing to expand, it should have a positive upward slope, right? In my opinion. So I think when you think about valuation, I think when you kind of think about it in isolation away from other macro variables, like the cost of money, the level and kind of strength in US dollar or vice versa, those kinds of things really matter in terms of understanding valuation. I'm not sure that the average investor factors that in. When they think about valuation is, hey, what is the company A or, the country A going to do from a policy or earnings perspective? And then let me kind of look at the multiple relative to some unit of comps and, or some group of comparables. And is this cheap? Is it expensive? What's the valuation on a longer term time horizon? Is it cheap or expensive? And at the end of the day, you're not answering the real questions, which is what are the conditions that cause XYZ valuation to happen? And are those conditions sustainable? And if they're not sustainable, when are they going to change and what's going to cause them to change? That is how you should be approaching the concept of valuation, in my opinion, which again, I think we're doing all of that stuff and just stopping shy of the actual valuation component, because to me, I think it's the least relevant piece of information in that entire kind of discussion.
Yeah. Evaluation is tough, both from the perspective that can be wrong for really long periods of time, but also to your point, like, let's say I even think, the CAPE ratio is going to, mean revert. What is it going to mean revert to? Is it going to mean revert to the 100-year average or the last 40 years where it's been way above average? Like, which one are we going to? It's very, very hard to use this for any kind of practical investment implications.
100%, man. I say this all the time. One of my favorite sayings is average is one of the most dangerous words in finance, especially when you're talking about valuation, right? Because something's, like we've heard this year, like, stock market's back at its, average valuation. One, you hear these nonsensical stories from financial media. It's like, one, average of what duration, right? They don't even tell you what duration they're looking at in the damn story. But two, it's like when you pull up a time series, particularly valuation based time series, they spend literally no time at the average. Like the average is like, it's a statistical concept. It's not an empirical thing. It's not real. It's just something you just determined is the average based on whatever sample you selected. And so this concept that something is cheap when it gets to average, or something is very cheap, cheap when it gets to average, or cheap when it gets, a standard deviation oversold in terms of the sample, there's sampling bias associated with that, kind of decision you're making. So, and not only is there sampling bias associated with that decision in terms of the time horizon you're looking at, but there's also sort of, kind of cognitive bias associated with not paying attention to why valuation got to the place it got to in the first place and the sustainability of those drivers.
Yeah, my favorite example of that average thing is, the market has an 8 to 12% average return over time, and it almost never has an 8 to 12% return.
Thank God for somebody to say that. Yeah. Yeah.
Just a couple more before I hand it back to Justin. One is this is sort of outside of your 42 macro framework, but I'm wondering, do you do any startup investing, any venture, like private equity? Do you any kind of that kind of stuff?
Absolutely. Yeah, absolutely. So as I mentioned, I run all my liquid net worth with the 42 macro portfolio construction process, but I also have a pretty sizable investment in a company, a tech company that my friend owns and operates.
And my last one before I hand it back is, you're kind of unique in the way we are, and that you run a business in the investment industry. And I always think about that in terms of building my personal portfolio. And I guess since you're using a systematic framework, it doesn't really apply as much, but, I always think about, should I be taking less risk in my personal portfolio because I have so much tied to the market in terms of the actual value of our business and my income and stuff like that. So I'm wondering how you think that through. I guess your process sort of handles that itself, but I'm just wondering how you think that through.
Nah, man, I say lean in, dude. You're good at this. You take advantage of your skill set. You don't think Dr. Dre listens to Dr. Dre and Snoop Dogg music? like, of course he does, like, yeah, if you're good at something, take advantage of it, it'd be preposterous to not take advantage of your skill set if you have a good skill set, obviously, you're talented at what you do. So I say lean in. I mean, hell, I'd spend 15, 16 hours sitting in this chair every day. Might as well take advantage of that output. So, if you're not, again, I'm a big believer in eating what you cook, whether if you're a cook or a macro risk manager like myself. At the end of the day, like if you're doing something, these are my hands. This is the work that I'm doing with my hands. If I don't feel comfortable living in a house that I built, I shouldn't probably have any of my customers living in that house at the end of the day.
And this I guess relates to, let's build off of that a little bit, because we had Jim O'Shaughnessy on the podcast. He talked about like two failure points for investors. One, a strategy can deviate from the market and an investor can make a bad decision of getting out of the bad strategy. Or two, the market goes down, whatever, 30, 40%, and they sell at the wrong time. So I'm wondering, I don't think your investment strategy or your personal portfolio probably would have that type of max drawdown based on how you're explaining it, but it probably can deviate a lot from like the broader market or the 60-40 portfolio. I mean, you're in there, you've created it, you believe in it, so you're going to stick with it. But for others where this might be a little bit complex or a little bit like, maybe if they have, their portfolio, this is like a 40% allocation that they're allocated to something like this. It might not be the entire thing, but the strategy goes through like a top 5 or even 10-year period. How would you advise those types of investors to make it through? Is it just, you got to believe in the strategy? It's built on, long-term data and it's built on managing risk. I mean, what would you say to that?
Well, I mean, if I can't generate returns over a long period of time, I just suck at my job at the end of the day, right? There is a human being making subjective decisions at a critical point in the process, which is, once we get to the place where we understand the relative units and expected risk and the expected reward, there is still a human being saying, well, let's say, for instance, go back to pick on crude oil. Crude oil might have a very similar kind of return profile as cotton. Well, I feel like I know more about crude oil, so I'm going to be, I'd rather be long crude oil than cotton because, cotton, there's a lot more kind of open the envelope risk because of my lack of understanding of what drives the cotton market. So there is subjectivity to that in terms of, understanding like, just which risk is Darius Dale comfortable taking, comfortable explaining to his customers and clients, in terms of that. So there is that process, part of the process. In terms of like managing drawdowns and like trying to avoid like, how do you respond to these kinds of big drawdowns? And no, so not even drawdowns, big sort of tracking error relative to 60-40 or relative to S&P. I mean, that's by design. As I mentioned, again, the goal for this portfolio is 7 to 10% returns compounded. Now, of course, I say that out loud and I'm going to get sued for not delivering 7 to 10% returns compounded for the next 30 years. Obviously, I'm joking, but that's my personal goal. So when I make decisions in the 42 macro portfolio construction, our customers and clients understand, hey, look, this is what I'm trying to achieve. There again, as I mentioned, there are times to be long, tons of crypto and tons of this and tons of that. And ultimately that'll feed into the kind of rolling average return over time. But there's also times to not be long to anything. I mean, we had different points of this year, we were in 60, 70, 50, 60% cash at different points of this year, and the whole goal of that was to create tracking error with the 60-40 portfolio, which I think is down somewhere like 20% year to date. We're up 1%. It's not anything to write home about, but I'm very glad about that tracking error because it was deliberate and it was by design. Now, the goal, obviously, if I'm doing my job right, is to, when we get to a better, more kind of comfortable place to invest from a capital appreciation perspective, that we, with that tracking error gets minimized. When we do want to take equity and fixed income risk, on the long side, minimize that tracking error, start to participate more, start to get some up capture. But right now we're really focused on preventing that, limiting that down capture ratio.
When you think about your own portfolio, I don't know how long you've actually been deploying your own strategy with your own assets, but when you think about your whole entire investing history, are there any big mistakes that jump out at you? Just because we can learn a lot from our mistakes. So we'd like to ask, like, what mishaps maybe have you made along the way that have kind of got where you are today with your investing?
Yeah, there's a couple things. Like, one, don't trade short-term options unless you're really effing good at trading short-term options, which there's probably, I don't know, several thousand people on earth who can do that well. Yeah. And most people listening to this podcast are not among that several thousand. It's an easy way to lose a ton of money. I joke and say like the short-term options are like the capital graveyard. If you want to leave some flowers at the Capitol graveyard, definitely trade as many short-term options you want. So that's kind of like one lesson I've learned, which is just, stay out of that because you're probably have less edge than you think you do. Um, Two, just sort of, a lot of times where I'm trying to, I think about risk in terms of, this is something I've had to learn the hard way, which is kind of thinking about risk at the individual factor exposure level and not really understanding how, eliminating this particular risk might affect the overall performance of the portfolio. For instance, like, hey, I'm going to stop myself out of position A, B, or C. And then once I stop myself out of position A, B, or C, let's say that was an inopportune time to stop out, right? Now, the whole entire portfolio is not generating the kind of return that I wanted to because I've taken, this particular portion of the return strategy out, right? It's like, imagine trying to play a football game and you bench all your wide receivers. Well, you're probably not gonna be able to pass the ball very well, right? And so that's kind of the kind of key takeaway from that lesson, which is when you make changes at the factor exposure level, not just understand how this is going to eliminate a return or create a new, if you're adding a new return stream into the portfolio construction, but also understand how it may impact the overall portfolio construction in terms of, kind of what your medium term objectives are. I think that's something that's a lesson I've had to learn over the years. I'm trying to think of something else. Everything else is, just learning from everyone else's mistakes. You got to be a student of investing, a student of economic history to do this job well. To really just, and fortunately, you have services like yours and mine to teach investors, to kind of help us, because again, it's not just I'm making all the mistakes. We've all made mistakes and we're all learning from each other's mistakes, which is how we get investing podcasts, investing services, investing books. So, I wouldn't say anything else on top of that stuff.
I think that's a good point though. When you take something out of the portfolio, you're taking out something and you might be adding risk here without even really knowing that.
Totally. Totally. Absolutely. Yeah. You got to think about it.
Just one last one on this run here. Do you at all view your current housing or anything with real estate as part of your overall portfolio, or do you kind of chunk that onto a separate thing? Like a lot of people view their houses, it's not an investment, they live in it, or maybe they don't even own a house, maybe they rent. Is there anything there that you think about?
No, I think about that as just a separate bucket. Yeah. So when I say when I'm talking portfolio construction, that's pure liquid net worth. Not even including kind of alternative investments like venture capital, et cetera, housing.
As we get to the end of these, we always like to ask a question that kind of gets this idea that, all investments that are good investments don't necessarily make money. And so the example I always give for myself is, I own a racing sailboat, and a racing sailboat is a horrific investment. I mean, the thing just burns money, but I've gotten a lot of joy out of it. I get to go out with my friends and have a beer. It's something I've gotten a lot of value from in my life. And I'm wondering if you have anything like that in your life where maybe it's not the greatest financial investment, but it's something you think has been a great investment.
Well, it's funny you say that. Prior to COVID, I would have said my car. I have a Maserati Levante. And I was like, I'm like, this thing is going to lose money, but I love driving it. It's a freaking beautiful, awesome vehicle. I love Maserati and that brand. But, prior to COVID, used car prices didn't go up. So, so now I can actually make money on this thing if I sold it. But no, it's, generally speaking, no. I mean, at the end of the day, this goes back to our first discussion, right? It just understand your investment objectives, understand your life objectives. That Maserati has nothing to do with my investments. I just enjoy driving the car because it's really cool and it's fun to drive. That, I don't think about that car when I think about, making a allocation or portfolio construction change. So no, the answer to that is no. But again, just understand yourself, understand your limits, understand your limitations, understand that you're a human with behavioral heuristics and you're probably going to be prone to making errors. And so what you're trying to do as an investor is take your mind off of constantly doing things for success and really refocus your mind on constantly trying to eliminate the tails of non-success. And I think if you do that, you're going to be left with a bunch of stuff that's, kind of generally, kind of making money and compounding returns, which is ultimately the goal. At least that's my goal.
That's great. And we like to ask sort of a standard closing question, which that answer might fit perfectly into what I'm going to ask you here. So if it does, that's completely fine. But if you could impart one lesson that you've learned from building your personal portfolio to the average investor, what would that be?
Ooh, this is a good question. Good question. I would say, risk happens really quickly. And so, when you get yourself into a bad situation, what people tend to do is they start risk managing their P&L. They start looking for, ways to get out of positions, levels to get out of positions. And they start playing doctor. They're sort of in triage, right? And the reality is usually when when you're in those moments, that's usually the market giving you new information about the evolving distribution of probable economic and policy outcomes. And so in that moment, your focus should not be in playing triage in your current holdings, but more importantly, trying to understand, holy shit, something, sorry for the language, something must be changing really quickly and really meaningfully from a macro and policy catalyst perspective, that I need to really focus a lot of my attention on that. And once you do that, then you can go back to playing triage or whatever version of triage you need to play based on that new information. To me, I see it all the time. Like even I feel it as a human being, when I have a, bad run. I had a crappy job. We were having a phenomenal year, up double digits, I think, in mid-June. And now we're up low single digits, right? They had a significant drawdown in July. The market went straight up, and we were calling it short throughout that month. And the entire time I was constantly having to fight myself from just playing triage and stopping myself out. And what I really focused myself on, I spent a lot of extra time just trying to understand, okay, what's driving this? How sustainable is this? And ultimately, there were some very positive fundamental drivers. We don't have to go into that in this particular podcast, but there were some very positive fundamental drivers. And so at the end of the day, as a portfolio construction, from the perspective of the portfolio construction, you did have to make a few minor changes. We're still leaning that short, the market, but we had to make some adjustments based on the specific factors we were along, because the probability of outcome ABC, we don't have to get into the details, actually rose. And so to me, that's a great example of, okay, let's just not play triage. Let's actually do the work in understanding why we need to play triage in the first place, because in those moments, usually you're getting some very significant, meaningful changes in kind of the macro drivers.
Darius, this has been great. Not everyone is comfortable coming on and talking about their own personal investments. I think the nice thing with your situation is your investments are aligned with your, the strategy that you follow day in, day out, and that you share with your subscribers. So if people want to learn more about your macro approach to investing, where can they go?
Yeah, absolutely. Appreciate it again. Thanks for having me. And always a pleasure to connect with you guys and connect with your audience. So definitely come check us out at 42 Macro. As I mentioned, we help investors construct portfolios, think about asset allocation on a cyclical and strategic basis, across, a variety of different firms and firm sizes. As I mentioned, we have some of the world's most respected institutions who are subscribed and are clients. And we have, retail investors, high net worth individuals, RAs, et cetera. As I mentioned, if you're investing, I say this all the time, if you're investing at all in capital markets, you are making macro bets. You might not have a process to make macro bets, and you might be deliberately putting blinders on, a la, venture capital, angel investing, et cetera, but you are still making a macro bet. So you might as well educate yourself on some of these critical macro factors and cycles that matter, so you can ultimately make better macro bets, because burying your head in the sand is not a solution, in my opinion.
Great. Thank you, Darius. We really appreciate it.
Thank you.
Appreciate you guys. Justin, Jack, thank you.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.